Welcome to New Wine Church Financial Services Team presents Financial Growth in 2021 and Beyond. Thank you for joining us today, which is Saturday, the 20th of March, 2020. It's an absolute pleasure to have you all today. Now, before we get started, let's do what we always do, which is the disclaimer. So, as we're about to do the disclaimer, we've got a poll that has just appeared. Now, if you wouldn't mind taking a moment, please, and just answer the general poll question. The poll question says, do you understand the 2021 budget? So please either answer yes or no to that one. The question number 2 is, have you considered how the pandemic would impact your finances post-lockdown? The third question is, have you considered the economic and investment outlook post-lockdown? And I hope you can all see the poll questions. And the fourth question is, do you have a plan on how to reposition your finances to grow as the economy rebounds? And the fifth question, of course, is, whether you benefited from any of the government schemes. So let's have a look. Let's see. You see, it's kind of a 50. Most people do not understand the budget. I'm with you on that one. A lot of people haven't considered the impact of the pandemic. So it goes to show that we're doing absolutely the right sort of webinar. If we can just keep the poll up for another sort of 40 seconds or so, we'll just give people enough time to do that. While you're doing that, let me start with a disclaimer. The information contained in this presentation is for educational purposes only. The presenters are not financial advisors. There is no recommendation or advice on making any financial investment or business ideas. Opinions and ideas expressed are those of the presenters and do not constitute financial or legal advice. Whilst care has been taken in compiling this presentation, the presenters provide no guarantee or warranty concerning the reliability, accuracy, or completeness of the information. The course presenters are not liable for any losses or liabilities which arise from the use and application of this material presented. Individuals should exercise caution and make their own decisions and seek the services of a registered financial advisor. Now, let's see. I think we're happy with the results of this poll. And don't forget to minimize the screen. If not, you will continue to see the poll up. So let's talk about the agenda this afternoon. So this afternoon, we're going to be looking at the global economic outlook. And that's for 2021 and beyond. With regards to the budget, we've already asked the question, do you understand the budget? And a lot of us have said that we absolutely do not. So you're absolutely in the right place this afternoon. So we're going to look at budget 2021. We're then going to look at investment outlook, and then we're going to go into the breakout rooms. And the breakout room 1 is going to be budget 2021 and me, which is and you. So please don't forget to put budget in front of your name if that's the breakout room you want to go into. And room number 2 is economic and investment outlook post-lockdown. So don't forget that if you want to go into that breakout room, just put outlook in front of your name. So let's talk about the objectives, because it's important we have objectives this afternoon. So today, it's all about understanding the projection of the UK and global economy in 2021 and near term, understanding the UK budget 2021 and its implication for businesses and individuals. We're going to show you how to take advantage of the provisions of the budget. And finally, we're going to show you how to reposition your finances to grow as the economy rebounds in 2021 and beyond. And I must say, before I move on, it's an absolute pleasure and delight for me to present two amazing presenters who have been with us throughout this entire journey. We have Deji Jalakpome, and of course we have Emmanuel Agbedeyi, who have been presenters throughout this whole process. I will give them the opportunities to introduce themselves when it comes to their section. But all I can say for now is sit tight and enjoy this afternoon as I hand you over to Deji Jalakpome. Deji, over to you, please.
Thank you, Ms. Lola Sarah. Welcome, everyone. I hope you can all hear me okay. Welcome back for those who have been with us on this wonderful journey since June last year. And also, if you're new to these series, welcome as well. So I'm gonna spend the time for the next 10-15 minutes going through the global economic outlook. You've already seen the agenda. And what we're going to try to do is the first section, I will cover the economic outlook. The second section of the presentation will be by my co-presenter, Emmanuel, and he will cover the budget in a bit more detail. And then finally, I'll come back and finish off with an investment outlook. So without any further delay, let's get going. So global economic outlook. Well, I think it's fair to say that 2020 was a very challenging year. This map you can see in front of you is the recession or heat map of contraction of GDP across the globe. I will come to the definitions of GDP, so it's a lot clearer. But on this map, as you can see where my cursor is, only China was the only economy that actually grew in 2020. Every other economy was either stagnated or shrunk. So evidently, we had a very challenging 2020. But let's define GDP before we move on. So GDP is a very critical measure that economists use to measure an economy's output or production. But to make it more in a way, something you can resonate with, think of GDP as your salary. So what do I mean by that? Let's take, for example, you earn £10,000 a year. The idea there is you've gone to work, you've put in the efforts, whatever your job may be, and you get paid $10,000 every year. It's the same for any economy. We all go to work, we produce things, goods and services that are produced within the boundaries or the borders of a country over a specific period. Usually it's measured quarterly or yearly. That output value is the GDP. So just think of a GDP as the salary of a country. So let's look at some of the impact in more detail of the coronavirus and what was a difficult year in terms of GDP. You can see already very, very challenging for a lot of OECD countries. So what are OECD countries? These are very simply developed countries, countries that have very stable economies and also very advanced economies. And you can see Spain -9 in terms of GDP contraction. Now in real term, take again your 10,000 in terms of how much you earn a year. Imagine if somebody said, we're taking 900 or 1,000 pounds away from you. That's going to affect you significantly in terms of how you manage your life. But you can see a varying range of GDP contraction across the group. Obviously, I will circle in a bit more for the UK, but I just wanted to give you a flavor of what was happening globally. Going on to the next slide, this again, just without going into too much detail on this slide, I think you can probably dissect this for yourself when you get the slides, but you can see this is not just something with advanced economies, we can see it in emerging economies as well. So whether be it Nigeria, where some of us are from, Brazil, where I'm sure some people are dialing in from, it's been negative across the board, negative except for China. But we are looking up, things are looking positive. We can start to see some positive projections. I'm not going to go into the details of specific countries because I really want the time. discussing closer to home. So let's look at UK annual GDP. The yearly contraction for the UK last year was minus 10%. That's significant for a major economy. But I don't think it's also fair to look at the UK without considering the impact of Brexit, right? I don't think that has been factored in as a exaggeration of why we've seen such a major contraction compared to other developed economies. The reality is Brexit hasn't gone away, or hadn't gone away at the time. And some of that impact you could see as well on output. But as I mentioned before, the forecasts are looking very positive. We can see that going into 2022, we're going to see a very strong rebound, 7% or so, before we see a normalization, which is where most developed countries are, around 2% growth of GDP. Now, a new wine, and at these seminars, we don't like to leave you with just a bunch of data and stats and facts. We want to equip you as well with the right tools to be able to look at some of these things and actually say, that makes sense. When I look at this sort of data in 12 months time or in 3 months time, I can take the tools that we give you to assess things for yourself. Now, obviously, you're not going to become an economist overnight, but these are just basic tools to think about some of these economic representations. So I'll give you a framework for assessing economic recovery or growth or contraction, as the case may be. The first one is productivity. Well, what's productivity? Very simply, productivity is, imagine you have a set of tools. If you can do more with those tools, you are more productive. And being more productive means you can get more products, services out there. And by producing more, that reduces your cost of production. So by reducing your cost of production, things evidently become less expensive. And if they're less expensive, they become more affordable. If they're more affordable, there's more demand for those things. And therefore, you see an economic rebound. So that's why productivity is such a critical measure when you're looking at economies or economic recovery. A lot of this will make sense as we move into the budget as well, because we're trying to tie the big picture first, so that when you start to see some of these details in the budget, you can understand the connection and some of the decisions and why the government is taking certain steps. The second one is human capital. So human capital, I'm sure a lot of us hear this all the time. Companies say our biggest asset is our people. That's because in people's heads is where creativity lies, ability, knowledge, skills. If you have skillful people, if you have knowledgeable people, the chances are you will get better results. So the smart people are the ones who deliver better results. Now, from a UK perspective, with Brexit that has happened, this is something that is potentially a challenge for the United Kingdom, because we're starting to see a bit of brain drain in the sense of good talent and skills and money, because talent tends to follow money, leave the UK. So that's something to watch going forward, especially on these economic forecasts. The third one is the labor force. I can hear someone saying, well, how are you working out that more workers equals more buyers? Well, think about this. If you have more people in the labor force, it means you can produce more. If you have more people producing more, those more people have more money in their pocket. So they're more likely to buy more things. And so a very, very tight labor force or less unemployment is actually good for economic growth, because if you have more people out of work, it means those people are relying on the states, affecting the government, and less people are buying things, which is obviously not good for economic growth. Hence why you've seen a lot of these extensions in terms of the furlough scheme, the restart grants for businesses. The government have done an amazing job trying to keep people in the labor force, because they know that if they don't do that, we will be in a lot of trouble. So again, think about how all these things tie into the budget as we go into that in the next section. And finally, I'm going to finish on technology. I think this is quite straightforward. If you have technology, if you have a laptop, pen and paper, you're more likely able to calculate very quicker numbers and spreadsheets. So technology is highly correlated to increased productivity. And you've seen a lot of measures that the Prime Minister, sorry, the Chancellor has given to startups and established tech firms, even the visa reforms to try and get better talent back into the country, the 375 million future fund, and some of this Emmanuel is going to go into more detail on. Now, I've only got 5 or 6 minutes left in this section, so I'm not going to go into a lot of detail on each country. I just wanted to show you this as a flavor of this is a challenge that you're seeing across the globe, right? The contraction in terms of the labor force, unemployment, et cetera, et cetera. We live in the UK, so I'll put a lot of my attention on there and touch on some of the other pillars of the framework that I showed you. However, the big one is really unemployment. So now let's look at, so now you guys have a good picture of, okay, I understand the framework now, I can see why these things are broken down. Let's look at some of this information. Again, let's focus on just unemployment, which you can see me underlining there. In 2019, unemployment rate was 3.9%. And you can see that jump, obviously, a 4 to 4.5% for obvious reasons, as we know. Naturally, 0.7% jump doesn't seem like a lot, right? And perhaps, sorry, excuse me. And perhaps when you start to look at numbers going up to the peak of 5.9 in 2022, you might say, that's still 1 point, just over 2%, et cetera, et cetera. I think let's make these numbers real, because I think people relate better to these things when they're real numbers. The labor force in the UK is 34 million people. In 2019, there was 1.3 million people unemployed. In 2020, because of the coronavirus and the amazing job that the government did, it only ticked up about 200,000 or 250,000, so 1.55 million people unemployed. By the peak in 2022, there's going to be 2 million people unemployed. And this is only because of the job that the government did. So if you took the effect of what they did away, you can imagine the unemployment rates and the levels it could have got to. But even still, we can all agree that 700,000 people out of jobs is not good for the economy. So these, again, are the factors and figures that you need to watch as we come out of this pandemic. I also mentioned productivity, and you can see that that starts to tick up over time. But I hope that is giving you a flavor of how you think about some of these things when you see the forecast. As I mentioned before, obviously all this comes at a cost. You can already hear the Chancellor saying, we're going to go all in, we're going to support the economy, but at some point, taxes will go up because we have to pay for all this debt, right? It's not just going to go away. So at some point, these things have to be factored back into our recovery path post-pandemic. Let me give you some quick numbers and a flavor of how these debts are piling up. So you can see at the top here is the UK debt ratio. Now, what is a debt ratio? Basically, for every pound that I earn, I owe X amount of pence. So if you look in 2002, I would say roughly where my cursor is, that was probably around 25 pence. We owed, as a country, we owed 25 pence for every pound that we earned. And you can see how that has surged through the financial crisis and now to the global pandemic. At some point in the coming years, we're going to be one-to-one. So for every level of income that we get, we owe a pound for that. Now, you can imagine these sort of levels are not sustainable long-term. So these are some of the things that we are going to have to think about. How do we pay it back? How do we restructure the debts, et cetera, et cetera? I've put some representation of the US here as well. By 2050, the US is going to owe $2 or $2 for every dollar earned. I mean, that's obviously unsustainable. So I think there are going to be measures that the government is going to put in place over these years to be able to manage that. And finally, on your right-hand side, we started off at 12.5 billion when this pandemic started. And look at where we are now. The budget accommodates in almost 350 billion just to combat this virus. So this is significant, and this is something that will be at play in terms of how we see things going forward. Again, I put this to just demonstrate the points that I've tried to make. The forecast, which is the red line that you can see, is the new projection based on the measures that the government is taking. If they didn't take those measures, some of these rates could have been significantly higher. So they are doing an amazing job to try to keep the economy moving, and some of these things will translate into the budget section that Emmanuel is going to cover shortly. So let me just summarize what I've been through. We're living in unprecedented times. It goes without saying. We're seeing very strong government and central bank policies. Everybody is whatever it takes, because we've also learned from the scarring of the global financial crisis, which happened 10 plus years ago. You can see the extensive furlough schemes, which we'll go into in more detail, low interest rates as well. In the US recently, if you follow that market, 1.9 trillion COVID relief bill has been passed to support the economy and also keep things going as well. Secondly, we're seeing really strong, robust vaccination programs. The UK is leading the way. The UK is doing a very good job. We have about 25 million people, I believe, at the moment, who have taken their first dose. So again, we're in a health crisis, so we have to deal with the health problem to really stand any sort of long-term chance of coming out of this pandemic. And finally, I think on the flip side, you can also see this rhetoric around the K-shaped recovery. It is a challenge. This pandemic has exposed our societal fragilities, and you can see some of these things coming out more. We have the rich getting richer because they have all these assets and things that are improving in value, but they are still the poor who are getting left behind. So I will finish here and I will hand you over. Now you guys have got a big picture over to Emmanuel, who's going to then drill into the budget. And I'll come back at the end of that to discuss the investment outlook.
Thank you, Deji, for that presentation. And thank you everyone for joining us for today's session. I'm going to be taking over from where Deji stopped and to explain to us the budget. As a result of the economic outlook that we've listened to, government have decided to respond to what we've seen so far and what they're expecting to happen in the next couple of months and over the years. And what they've done with the budget is to try and see how they can address the imbalance we have in the economic situation, and also to make sure that the economic that we have pick up and begin to make the citizens to live a better standard of living. Now, talking about budget, what is the budget? I'm going to be going through and discussing what exactly budget is. And I'm sure most of us that we hear, either formally or informally, we do budget. Also, there are different types of budgets. Individuals prepare budgets, which we all do, I'm sure, maybe on daily basis, on weekly basis. When we want to go out shopping or we want to buy anything at all, we look at the income that comes in and then look at the likely outflow, direct debits, all the bills we need to pay, and then decide either to buy something or not. Indirectly, what you're doing is preparing a budget, and that is what an individual does. Also, we have businesses that prepare budgets. They prepare budget to make them to understand how the income is going to look like, or the revenue they're making is going to look like, and what are the things they're going to spend money on. So if they have a shortfall, they decide either to go out and get a loan, or to try and manage their expenses or delay some of the payment they need to make to their suppliers. So that is where we have corporate bodies and also organizations that do budgets. Then we also have the government, which is what we're talking about today. And oftentimes, the government budget dictates what happens in the corporate environment and also individual lives, because a lot of the companies will always wait for the budget to be announced so that they will know the direction that the government is taking in terms of the policy and then they can make sure they respond to it appropriately. Otherwise, they may be spending money on the wrong areas of the economy, whereas government is trying to focus on another area. And also, we're going to understand why we have two types of budget, or two different budget announcements in the UK. We have the spring budget and also the autumn budget. Now, what is a budget? I've explained that already, and I'm sure most of us already understand what a budget is, but I'm still going to just try and explain to us at a high level. Budget is more of a financial statement of a company or of a government, whereby they highlight what their revenue is, the inflow or the income they earn over the years, and also what the outflow is going to look like. And when you look at the budget, you will have a view of more of a financial statement of that particular country. You will know how much they're owing, how much asset they have, how much money comes in different forms, and also how much money they're spending on different aspects of the economy. Many of us, I'm sure we get statements from the government that tell us about our tax when we pay tax. At the end of every financial year, they always tell us, okay, for every money we earn from you, 1 penny goes into this sector, 50p goes to this. That is the sign of trying to tell you an idea of what the budget, how they've implemented the budget over the period of time. And also the budget will also give you an oversight of the government policy on how they want to drive the economy to improve this situation of things in the country. When you look at a typical budget, there are sources of income and also there are outflows. The major one you're going to see mainly are taxes. Most countries in this part of the world, they depend heavily on taxes that come in, and that is in the UK now. There are some countries that the main source of revenue could be maybe the mineral resources that they have, maybe oil and gas, or maybe any other mineral resources that they have. But from the UK point of view, the main source of revenue for the government is the tax that they earn. It could be a direct tax, which could be the income tax we pay, or the corporate tax that companies pay, or sometimes indirect tax, which we pay, like when you pay VAT. When you buy things, most of the time when we go to stores to buy any item, there's always a VAT element of it. That is an indirect tax. And there are other sources also of income for government, which could be maybe selling assets. They could sell maybe some of the investments they have in certain companies, and then the money they make from there also will give them source of income. Also, sometimes they, if they've given out loans to people or to banks or to institutions and they earn interest on it, those are also sources of revenue for government. And when it comes to the outflow, there are two different ones. We have the capital and also we have the current. The current outflow represents what government spend on day-to-day, like paying of salary of civil service or running different parastatals, or the money that they pay on education or welfare. Those are current expenditure. But there's an aspect of it which is the capital expenditure. These are when government spend money heavily on infrastructure. These are areas that they believe that over time, they should support the economy in terms of generating income back. For example, when they do high-speed train, HS2, that is a capital expenditure. Or they try to do maybe a major road or constructing any particular infrastructure. Those are outflows also, but they are capital in nature. They're expected to last long for a period of time. So that gives us an idea of what government expenditure is like. And when you have budget, it can be classed into different types, depending on how the budget looks like. When the money that comes in a year and the money that is...
That's it. Okay. It's okay. No.
Sorry, can we please mute everyone, please? Thanks. When the money that comes in a year is the same thing as the money that goes out in a year, what happens is that you have what is called a balanced budget. But in some years, where you have the money that comes in more than the money that goes out in a year, you have what is called surplus. That means we have a surplus because the money you have as an inflow, and that in terms of the tax or the revenue you've made, is more than the actual expenditure you spent. That is called a surplus budget. But when you have the outflow being more than the money you're making, it is called a deficit budget. That means you have a shortfall. In most cases, one of the benefits of preparing a budget is to help you to see that the money you're going to make in a particular year will be less than the amount you're going to spend in that particular year. And then government can plan appropriately and say, look, how do I get a difference? Do I need to borrow? Do I need to offset these by maybe selling some of the assets we have? or what are the things I need to juggle around to make sure I can fund the expenditure. And that's one of the benefits of budget. And most of the governments we have in the West during the last 12 months will have a deficit budget. And one of the importance of having the budget is it helps you to manage your financial resources and how to support the programs or the projects that the government is trying to run. And the other part also is that it helps government to prioritize which programs to do first and how they can make sure that they improve things for the benefit of the citizen. There are different roles that the budget plays. I'm not going to run into all of them, but if you look at the screen, what you'll have seen is we've listed about 7 of them. One of them is economic growth. Government would put money in areas where they know will help the economy to grow for the betterment of the citizen. Also, one of the benefits is reducing regional disparities. You will have heard a lot of times that government is saying they're spending money in certain parts of the country because they believe they're underdeveloped as a way of bringing them up. So those are the things that you see in the budget because they will have analyzed the situation of all the parts of the country and decide where do we want to put more money in. And we're going to see that also as we go along. Now, coming to the UK budget, as I mentioned before, normally we have 2 different budget announcements in the UK. One is the spring and one is the autumn one. The spring budget happens in March. Normally the fiscal year, or what some people call maybe financial year of government, runs from April to April. So what happens is that before the financial year starts in April, government will always come before they start in March, which is always a March. And then they will do the announcement to tell everyone, this is the direction we're going. Before the financial year starts, this is what we're looking at, and this is what is going to happen. And in March budget, which is the spring budget, that is where they announce all the major policies. So that is why a lot of companies always pay a lot of attention to the spring budget, because most of the policies of the government always come up in the spring budget. And that is where you have a detailed analysis of all the budget. If you look at the last budget that we have, it's about 110 pages of the budget. There are a lot of addendum that you see eventually that will come out, but you have all the detailed policy announced for the next 1 year, and they also say whatever they need to do over the coming years. Then in the autumn, there's also another one, which is basically by the time you are halfway into the fiscal year, which is 6 months into the year, and that is always in September, government will come back and say, look, in addition to what we told you before, we've seen it for 6 months, perhaps certain things have gone differently from expected. As a result of that, now we are giving you additional announcements to what we told you before. So it's like an addendum or additional announcement to what has happened, but it's always very less compared to what you have in the spring budget. So this autumn budget is always high level, just a few things are announced, and there's hardly any major policy changes that happen in the autumn budget. But the spring budget, which is always before the fiscal year starts, is where you see most of the major government policies being announced. And I hope that's giving us an idea of what the budget looks like. If you look at the screen, what we've taken is to take a snip of some of the things we have in the 2021 budget that was announced by the Chancellor of Exchequer. If you look at what you have in front of you, to the left is the income, to the right are the expenditure. And if you look at the example we have here, at the right, at the bottom, for 2019-2020, you will see that the total income or receipts that was mentioned by government is about 828 billion, while the expenditure is about 885. That shows to us that the government has what? A deficit budget. And definitely it has to be funded one way or the other. And if you look at also all the subsequent years, 2021, 2020, 2021, 2022, all the way through, basically every year from now on is showing that we're going to be having deficit budget. And we all know one of the reasons why that is the case. We've had a pandemic affecting global economy throughout the last year, which was also mentioned by Deji in his earlier presentation. As a result of that, the money that will be coming into government is less than what they're spending. And also government will be trying to fund more of the economy so that economy can pick up in general. So that gives us an idea. So if you want to have a look, there's a link in this particular slide. When we get it, you can click on that link. It will take you to the budget itself. So you can look at the entire budget and see what are the things that are hindered. Now, I'm going to be going into the details of the budget itself. What I want to mention is that as we go into this budget, I want us to make sure we take note of each of the schemes that we're going to be discussing, because at the end of this presentation, I'm going to ask us to choose top 3 areas that we want us to discuss in detail when we get into the breakout session. So what the highest number of posts we have will determine which areas we're going to discuss in the breakout session. So please make sure you note it down, everything in terms of the scheme, so that you can know exactly which ones to choose. When the budget was announced on the 3rd of March by the Chancellor of Exchequer, he mentioned that the budget is set on 3-point plan. Number 1, to support businesses and families through the pandemic so that all of us can survive it. Number 2, to strengthen public finances once we're in recovery, which is the whole idea. Number 3, to begin to work on building our future economy. We don't just talk about surviving the pandemic, but at the same time, we want to make sure we have a thriving economy going forward. So those are the 3, let me say, pillars that the budget that was announced by the Chancellor of Exchequer was built on. And that is the basis on which we're going to be discussing today. So the first one, which we're looking at, is what are some of the schemes that government announced that is going to support business and families. Now, I need to point out that there are so many things that the government announced in the budget. What we've done is to pick about 20 or so of some of those schemes that we believe will be relevant to this audience. And those are the ones we've picked here. This is not everything that's in there, but we've picked the key ones that we are of the opinion that will be relevant to most of us here. And also some of these things will not be specific to us. So can we please make sure that even it may not be specific to you, your family, your friends, your loved ones also may benefit from it. So you mean go say, because I don't have a business, I don't care about the support for business, but your friend, your brother, uncle may also need it. So let's just make sure we understand exactly what are the support available. So the first one we're going to look at is the support that government is making available to business and families. The first section, we're going to look at the support available to individuals. Number 1, follow. I'm sure most of us, we've heard about this, we've seen it over and over again. Government decided to support people who are out of jobs. They were working before, but they've been told because of the fact that the business is not running as expected, the employer have put them to say, look, go and sit down for now until the economic picks up, we're going to call you back. So they've been put on follow. What government has done is that they have 3 different grants that they've supported them with. So government is now decided that they're going to be they're going to extend that support of paying 80% of their salary until September 2021. It was meant to end in March, but government has now said they're going to run it until September 2021. So, but there's a cap. What they're saying is that they're going to pay up to a maximum of 2,500 a month. So if anyone is earning 5,000 or 6,000, the cap the person is going to earn, the maximum is 2,500, and they're going to pay only 80% of that. However, government now decided that they won't pay the 80% up to September. So what government has said is that they will pay up to June 80%, but in July, the employer will have to pay 10%, and then government will only pay 70%. Then in August, government will reduce the amount it's paying again from 70 to 60%, and then the employer will have to make up 20%. And then in September, they will remain the same thing. The reason government is doing this is because they believe that as we go through the year, the economy will be picking up gradually. So the employer should be able to pick up part of the bill while government reduces its own involvement. And the assumption is that by September, the economy should be up and running. Then those who are needed to do the work can go back to do their work. One of the things that people always assume is that when you're on follow, that means you're on follow for too long. Some employers, what they do is that they may use maybe the staff for a period of time, and then the period they're not working, that is when they claim the follows grant for. If we have anyone here that is an employer, all you need to do, if you've not used the scheme before, is you just go ahead and apply through HMRC, because what they're going to use is whatever salary that the person has been paying tax on. And then if we have anyone that is on follow scheme, they need not to do anything. All they just need to do is just wait for the money to be paid to them like their normal salary. One thing that I want to point out as we go along in all this scheme is that everything is tied back to the salary that is being paid. and the tax that people are paying to government, you will see that most of the schemes we're going to be mentioning will be tied back to tax, tax, tax. And that shows that those who have been paying the appropriate tax over the years will always benefit from government, but those who have not will more or less will not, because government is trying to repay back some of the tax that people have been paying in the past. That's what they're trying to do as a result of the scheme. Now, going to the next one, the Self-Employment Income Support Scheme. When the government first announced the support for the follow employees, a lot of people made a lot of complaints that they left out those who are self-employed. And what government did was to now come out with a support for self-employed people also. So they've brought out about 3 different grants, which was meant to end, but government has now decided to extend it to September, similar to the follow scheme. So the 4th grant is going to start from February to April. And government is also doing the same thing similar to what they did for follow scheme, whereby for those who are self-employed, who have been filing their return to HMRC, government is saying they're going to pay 80% of whatever profit they've been declaring, like more like on a monthly basis, which is about 2005 every month. They're going to pay 80% of that amount back to them as a way of supporting them through this pandemic. And for anyone to qualify, the person must have submitted the 2019-2020 tax return by the 2nd of March. So if you have anyone here who is on self-employment and who has filed his or her self-assessment by 2nd of March, they will qualify. As long as they've been impacted this way, they will qualify for that particular grant from the government from between February to April. The 5th and the final grant is going to be covering May to September. Now, for the May to September, government changes a bit. They have 2 different tiers. They have what is called tier 1 and tier 2. Tier 1 is that if that self-employed person, the revenue has dropped more than 30% in the tax year to 5th of April 2021, government will pay 80% of the average profit that they've made over a 3-month period. But if the revenue did not drop more than 30%, government will only pay 30% of that money. So it depends on how the drop in the revenue that individual is making, that particular self-employed person is making. So for those who have been filing, let me say, their tax return correctly, they will get more money from government. But one thing I also want to point out is that the money that is being given to us by government to these individuals will also be taxed eventually, because like income you're earning. So by the time you're submitting your tax return, government will assume that that's an income from you, and then you have to pay tax back to government on it. To be eligible, the individual must be self-employed, and the business must have been adversely impacted by the pandemic. And also, government has said anyone that is earning profit over £50,000 will not get this kind of support, because they assume 50K is a lot of money for a self-employed person. So such an individual will not get the amount. The next scheme we're going to discuss is stamp duty holiday. This has been in the news for a while. I'm sure a lot of us will have seen it. And that is regarding those who are buying homes. As a way of supporting the economy, government wants to support the economy to make sure the economy keeps growing. People who wants to live with their move on with their life want to continue that. So what the government has said is that for those who are buying houses in the UK, up to £50,000, sorry, in England and Northern Ireland, up to £50,000, that the government is extending the stamp duty that they pay, which is 3%, up to June 2021. So if anyone is buying a house and the house is not more than £500,000, they will not pay any stamp duty on that particular amount. So if you take 3% of 500,000, that is about £15,000 savings for the individual. What government now said is that from July to September, the rate will be dropped, the threshold will be dropped to 250. So anyone buying a house after from July, will pay stamp duty and any property above 250K. Then when it comes to September, it will go back to the normal threshold, which is 125,000. So the normal threshold is 125,000. If you buy any house in the UK, normally any house below 125,000, you don't pay stamp duty. Above 125,000, you pay. But because of the pandemic, government increased the threshold just to reduce the amount of money that people are paying. And what is the implication? That means government will be making less and less money during this period. And this scheme is only available in England and Northern Ireland. That is because Welsh governments have said they're only going to extend to June 2021. But for the Scottish government, which is within Scotland, they're saying they're going to end the scheme by the end of March. So for those of us who are considering buying a house, if you think the house is worth more than 250, you're better off trying to buy the house before June, end of June, so that you can benefit from the £15,000. But if the house is less than 250, then you can still wait till around September. But this is a huge savings that government is trying to help people to move on with their lives. But we know clearly this is meaning that government is going to raise less funds, and definitely at a point in time, they will have to address a way to make the money back. The next scheme that government is announced also is the mortgage guarantee. And that is to help individuals that are actually buying a house. That many people, because of the pandemic, will not have enough money to pay for the mortgage or the deposit. What government has done is that they've now gone back to the banks and say they will guarantee the money that people are buying with. So what is happening in this case is that 95% of the mortgage can now be made available to home buyers up to £300,000 house. As a result of that, during this week, I heard some banks are already selling mortgage products that are already 95% mortgage and 5% deposit for individuals, because government is guaranteeing it. I say, look, we are going to guarantee the fund. However, the banks will still be required to make sure they do their normal checks to make sure the person can afford the 5% and then make the repayment on the loan. But the caps for such mortgage is £600,000. But there are conditions attached to it. If you're buying with this kind of scheme, number one, you must live in the house. It is not available for you to use to buy a buy-to-let or to buy a house that is a second home. If you want to use it, you might have to leave your current home and then move to the new house as your own primary home. But it's not allowed to be used as a second home or buy-to-let or to buy a commercial property. Number two, also, it is available to either new build or to existing properties. And the plan is that this scheme will run out by the end of December 2022, though there are a lot of conversations going on that probably government may end up extending it further. Then if you're going to take this mortgage, one of the conditions also attached to it is that you have to pay both the principal and the interest when you're paying your monthly payment to the bank. It's not accessible if you're going to only pay interest only, as some people always do. So you have to pay both the interest and the principal every month to the bank. The other support that government has done to help individuals is by increasing the living wage. So government has increased the living wage to about £8.91 to help people to be able to increase their means of livelihood. And also at the same time, for those who are below 25 years, they've also increased their minimum wage, as you can see on the screen. And those who are eligible for tax credit, government is giving a one-off payment of £500. So if you know anyone that is eligible for tax credit, they are entitled to a £500 payment from government. And universal credit uplift is being increased to £20 a week for the next 6 months. Those are some of the schemes that government is placed out there to help individuals. In summary, we can see from what we've discussed so far that the government has extended the follow scheme to end of September, and the rates that government will be paying varies between 60% and 80%. Also, there's a self-employment support scheme that is available to September, but the eligibility is based on the tax return that any self-employed person will have submitted to government. The stamp duty holiday on 500,000 pounds worth of home has been extended to June, and then is reduced to 250K by September. And government is backing or guaranteeing a mortgage of up to 95% for those who don't have enough money to pay their deposits. And the national living wage has also been increased to £8.91, while those who are eligible for tax credits can claim money of £500 from government as a one-off payment. So that gives you an idea of some of the schemes that are available to individuals. Now I'm going to be looking at some of these schemes also that are available now to businesses. The first one we're going to talk about is the Restart Grant. As a way of helping certain businesses that have suffered significantly during this pandemic, mostly those in the hospitality, accommodation, and leisure businesses. What government is saying is that they are making available up to £18,000 grants to them. For the business to be eligible, number one, the business must be based in England. Number two, the business must occupy its own business premise and must have been paying rates to the local council, and also must have been affected by the national lockdown, which has happened throughout from last year till earlier this year. And the business must have been unable to do any one-to-one or in-person customer service from its premises. So those are the conditions that are attached to it. Furthermore, the amount that any business can claim is tied to the rate they actually pay in terms of the rateable they actually pay on the property. So if, for example, the rateable value of any property is £15,000 or less, the maximum grant that that business can claim is 8,000. But if it's between 15,000 and 50,000, the amount increases to about 12,000. And if it's more than that, then that business can claim up to £18,000. So if we have anyone here who runs their own business and they also pay, business rates, what government is saying is that all you need to do is just go to your local council, go online. A lot of the websites of the local councils will have the link. If they don't, what we advise is that you just call them and tell them you want to apply for the Restart Grant. It's a grant that you get and you don't have to pay back. As long as you fulfill this condition, you are entitled to get that money. It's part of the payment because government is funding local council for them to pay the money back. So what government is doing is trying to repay back some of the money that people have paid over the years, as long as they qualify for the grant. The next one I'm talking about is the Recovery Loan Scheme. Last year, government gave out about 3 different loan schemes. Now they're replacing it with a new one called the Recovery Loan Scheme. And what government is doing is that they are guaranteeing 80% of the loan scheme that will be issued by banks to businesses. So businesses can apply to banks and get this recovery loan from their bank. And it varies from £1,000 to actually 10 million. If an individual is trying to finance maybe an asset or invoice finance, they can apply between £1,000 and 10 million. But if they're trying to get a loan or overdraft, they can get between 25,000 and 10 million. Government has made it clear to the banks that are participating that they must make sure they don't put unnecessary hurdle before the businesses, because government itself is guaranteed 80% of it. So if anything happens, government will pay 80% of the money. However, the banks will still need to do their normal checks to make sure that the business can afford to pay the money back over the period of time they need to pay back. So that is why any money that is taken has a term. So for the loan, it has about 6 years, while the overdraft has about 3 years. And there is no restriction to any business that can apply for it. So any business, no matter the size, you can actually apply for the loan scheme through your bank, as long as you feel your business has been impacted. And the interest you're paying also is relatively low compared to getting a normal loan, because government is guaranteeing 80% of the money. So please, if you know that your business has been impacted by the pandemic, government is made this available. You can apply to your local bank. If your bank is not participating, because not all the banks are doing that, you can go to any of the high street banks. Most of the major high street banks are participating. They will give you the form, you fill the form, and they will ask you for all the normal details, and then make sure you're able to qualify. But please, if you don't need the money, don't apply for it, because you are expected to pay back the money. So as long as it's needed by your business, we recommend that you go for it. But the scheme is available to every business in the country. The next one is the business rate relief. As a result of the pandemic, a lot of businesses are struggling. And what government has done is say, look, most of the businesses that have been impacted most, mostly those in hospitality, the retail and leisure centers in England, can actually apply for their business rates to be suspended. And this is making supporting businesses to make sure that they are able to survive during this period. So all you need to do is just apply through your local council. They will look at the case by case, and then they will give you the holiday. It is a scheme that government is making available to all the businesses that are struggling, and government is funding the scheme also. So that is why it is a relief or a business rate relief holiday that government is making available, and this is going to run till end of June. June is because government is expecting that from then the economy should be almost back to its feet, and then people should be able to pay back their own business rate. So if you are having issues with the business rate, what government is saying is that you are allowed to get a holiday payment, or more or less, government will allow you not to pay holiday, pay business rates for as long as you qualify in that industry. In addition to that, there's also a scheme for the hospitality and tourism support. This started last year, whereby government reduced the VAT that those who operate in that industry are charging. They reduced it from 20% to 5%. And that is now been extended till September. You remember most of the dates we're talking about is September. And that is because by then government is expecting that the economy should be fully back on its feet and individuals can run their business also or get back to normal. So by they're saying the 5% is more or less reducing the amount individuals going to pay. Instead of paying 20% on, let's say, 1,000, which is about 1,002, you only pay 5%, you pay maybe just 105. So they are saying pay only 5% VAT. Then at the same time also, from October, the VAT will then be increased to 12.5%. And then when it gets to April next year, it will go back to 20%. This is one of the schemes that government is introducing to help boost the business of those who operate in the hospitality and tourism industry. As we all know, they are the worst hit when it comes to the industries in the UK because of the fact that they have been told to shut down and most people are not coming in for tourism. So government is trying to boost the business or economy in that regard. The next thing that we're talking about is the deferred VAT. As a result of the pandemic last year, government allowed businesses to defer the payment of their VAT. VAT, you collect normally VAT from customers, and ideally, it should be remitted back to HMRC because you're collecting the money on behalf of government. But as a way of helping businesses to manage their cash flow, governments allowed businesses to keep the VAT, used to run their business, and then pay at a later date. Now, the date for payment is now here. The expectation is that businesses are meant to repay back the VAT that they've earned between March and June this year. So for those who have not really been able to do, if you are not able to pay back by the 31st of March this year, you must reach out to HMRC and reach an agreement on exactly what needs to be done or how you're going to reach an arrangement of paying it back. Otherwise, there's going to be a penalty of 5% if no arrangement has been reached or no payment has been made. So we advise anyone who has a business that have deferred their VAT over the years, or over the last 1 year, to please either pay the money by the 1st of March 2021, which is in the next couple of, let me say, in the next 11 days, or reach out to HMRC to reach an arrangement on how to pay the money or agree a different plan. Otherwise, there's a penalty of 5% that will be charged on the money. Then the next point which we're going to discuss is regarding VAT administration. VAT administration is going to be becoming more and more digital. And also because of the fact that there are a lot of different rates that are being applied now, businesses should be able to make sure they have a system that will help them to be able to apply the different VATs that may be applicable. In addition to that also, VAT registration threshold still remains 85,000. So if you're going to make a revenue of up to 85,000 pounds in a year, government expects you to register for VAT. And if your revenue in a year is going to be less than 3,000 pounds, then you don't need to, you can stop registering for VAT. So there are a lot of complications that are involved, complexities that are involved. So we're just trying to bring this up so that businesses can understand what are the intricacies and what are the things they need to get ready to make sure they are ready. And also, there is this making tax data that the returns needs to be done online. So businesses that don't have that capability need to make sure they are ready for this when it goes live from 1st of April, 2022. And finally, as a way of government helping businesses, one of the things they've also done now is to now say that if you have a business that you're running, government is saying as a way of helping the younger generation, because some of the people that have been impacted most are the young people. Government is now saying those who have a viable business, a running the business, they can actually employ apprentices, and they will be paid from April to September 2021. They will be paid £3,000 for every apprentice that they take on. The amount used to be 1,005. So if we have people who have businesses here, and probably you have maybe a cousin or a nephew or a niece or someone that is close to you that probably is trying to find a job. What government is saying is that you can actually employ such an individual as an apprentice, as long as they qualify, and then government will give you £3,000 for taking the person on as an apprentice, which is a good money to have to give to the individual, so that instead of them being idle. So there's a way to encourage people to take on the young people so that they don't just stay at home looking for nothing to do. Then also payment will also be made on top of the 1,000 grants that are paid to apprentices that are between 16 years and 18 years. So what we're advising is that if you want to take part, if you run a business and you want to take part in this, one thing you can do, you have to do is you have to go on gov.uk website. There's an apprenticeship service account that you have to open. When you open it, then you can now apply for the incentive. So government will pay the money back to you to give you the money for taking on young people as apprentices. In addition to that, also to help the small businesses, government is saying that all business owners are eligible for 2 weeks sick pay that they give to any employee that they have. So if for any reason, maybe an employee working with any small business owner falls sick and they are off their payroll or they're off for 2 weeks, whatever money that is paid to them in that period can be claimed back from government as part of the eligible statutory sick pay. And apart from that, there are other things that support that government is making available to people all over England. So as a recap of some of the schemes that we mentioned so far, we can see that there are various grants that are now available for businesses through the local authority. So if you fall into that category, or you have a business, or you have a friend or family that falls into that category, please reach out to them and tell them that they can apply to the local authority for such grants. They don't need to pay back because as long as they qualify, we've told us the conditions. Also, there's a loan scheme that people also can apply for. If you have a business and you need a support in one way or the other, there's a loan scheme that is available through the bank that has been guaranteed by government to support your business until you fully recover. And the money doesn't need to be paid back overnight. Some of them run to 3 years, some of them to 6 years. The expectation is that within that period, the business should be able to pay back whatever money they've taken. In addition to that, we have business rate relief. If your business falls into the tourism or the leisure or the industry that we mentioned, you can apply to your local council for the business rate you're paying to be suspended as part of the business rate relief, because it's been extended by government. And the VAT also that people that the tourism and the hospitality industry are paying is still 5% up to September, and then it's going to increase to 12.5% from October to March next year before it goes back to what it used to be. So this is just a recap of some of the things that we mentioned. And if you look at all the schemes we mentioned, all of them are tied back to tax, tax, tax. What government is doing is that they've looked at the economic outlook. How have we performed in the last 1 year? What do we think is going to happen in the next 6 months or 1 year? And what government is trying to do with the budget is to respond to those things and see how they can actually help businesses and individuals to survive, so that by the time the economy is moving very well, people can then begin to go back to normal life. And all these are coming from the tax government. That means in some cases, government will be earning less tax. And that was why we saw on the budget that we said the government budget for this year and the next couple of years are all going to be what? Deficit, because less money is going to be coming to government as a result of the pandemic. And at the same time, they are spending more by funding businesses, by making loans available to people, by giving local council money for them to give grants to people, to businesses. So these things we've been talking about are all responding to the things we've heard about the economic outlook. Now, we're going to be looking at the other pillar. We mentioned at the beginning that there are 3-point plan. So the second plan we're looking at is how government is talking about strengthening the public finances. The first one is the corporate tax. Government is announced that from April 2023, the tax rate is going to go from 19% to 25%. However, it is not going to be applicable to all the businesses in the UK. So if you have a company that makes £50,000 or less in profit, you will still continue to pay 19%. If your business is making between 19 and £250,000, you're going to taper it you're going to increase from 19, but you're going to taper it and come out with a calculation and say, okay, these are amounts you're supposed to pay in terms of tax rate. But if you're making profit above £250,000 per annum, then the business will have to pay 25%. But what government has said is that even with this increase in the tax rates, we're still going to be paying, the companies are still going to be paying the lowest corporation tax among all the G7 nations. And it is also one of the ways that government is trying to use to offset the amount it's been spending, because we're talking about strengthening our public finance. More money needs to come in. The big companies will have to pay back their own share of trying to refund the economy. So this is a way that government is trying to use to make sure they get some of the money back. So what they're doing is that we're not going to do it now. We're going to allow all businesses to at least to come back to what they used to be. But by 2023, the big players in the market, those are classified, those who are earning profit over £50,000, they will be paying 25% tax rate. After that, government may decide to revise it again, may bring it down or increase it. But for now, that is the government policy. So if you don't make up to £50,000, you need not worry, because it's not going to affect your business. But the moment you cross £50,000 threshold, that means your tax is going to increase. But if you don't make 250K, it's also you don't pay 25% tax rate mentioned. The other scheme that government has is Help to Grow. This is the support that government is now making available to small and medium businesses, mainly those who have employees between 5 and about 249 people. What government is doing is to make available training to the management of these businesses by giving them a 12-week program across from a lot of schools and training schools across the UK to mentor them on how to grow their business, network them, and make sure they take advantage of all the various training that are available from some of the top business schools in the UK. And this is going to be available over 3 years. So if you have anyone here that falls into that category, you can actually apply to be part of the this scheme. Government is saying they're going to actually take care of the 90% of the cost of the training. So businesses that are interested will have to pay £750, but government will take care of the 90%. So they're assuming the whole thing is going to cost about £7,500. So government is taking care of 90% of the bill, and then only £750 will be paid by the business owners or those who are attending. But it's made available to all the small business owners. And if you look at the business must have been in operation for more than a year, and they must have between 5 and 249 employees. So if you want to participate in this program, which is only £750, but it's going to be delivered by top training schools across the UK, networking people together, give them practical ideas. The whole idea is to help people that have small businesses to grow their business because they want to make sure we strengthen the economy, have small business growing up. And I was looking at the OECD report, they said 99% of the businesses we have actually come from small and medium enterprises. So one of the things that government is trying to do is to strengthen that sector, even though they are not making the bulk of the money, but they strengthen it so that they can also generate more value as we come out of the pandemic. If you want to apply, you have to go on the government website and then do the application. So they're going to look at the screen, they'll look at all the criteria. If they get all the meet all the criteria, then you can actually participate. It's only going to cost £750, but the value that government is saying is that it's going to have a value of almost about 7,500, but they are willing to bear 90% of the cost. The next scheme is the income tax threshold. What government has said is that the threshold for the income tax that individuals pay this year is going to increase. So for those who are paying basic tax rate of 20%, they've increased the threshold to 12,570 from 12,005, increased by 70 pounds. So anyone earning 12,750 and below will not pay tax. However, after this year, that rate is going to be frozen. That rate is going to be frozen till 2026, which is contrary to what government has always done in the past, because almost every year they increase the threshold to make sure less and less people pay tax. Similarly, for those who are in the higher rate bands, which is 40%, what government has done this year is to increase the threshold by 270, which is now 50,270. But after this year, that threshold also will be frozen. Many people believe that, okay, look, government is not increasing their tax. However, the implication is that indirectly, we're going to be paying more tax. And that is because it's a hidden tax. In the last year budget and the years before, government announced that they will increase the threshold so that people will pay less tax. But because they've now frozen it, what's going to happen is that by the time people's salary gets reviewed or people get promotion or move to a new job and they get more salary, automatically they will now be paying tax that they will not have paid before. And that is what is called like a steel tax or as a hidden tax. And what Office of the Budget Responsibility said is that about 1.3 million people will now be dragged into the tax system who won't have paid before if government has stuck to their initial tax policy, which they changed this year. And also about 1 million additional people will now be dragged into higher rate brackets just because government decided to freeze the tax rate. So if you look at this next slide, this is giving us an idea of the tax implication. If government has stuck to the initial policy that they announced in prior years, in last year or year before or 2 years before, where they've mentioned that they will be increasing the threshold for paying tax every year so that less and less people will be paying tax. If you now compare that to what they've said now, that they're not increasing it again, what this shows is that for someone that is earning about £15,000, if the person gets a salary increase and all that, what he said is that now the individual will pay, in the 2022-2023 tax year, the individual will pay £92 extra. And if you look at that over a period from now to 2026, where government is saying they're going to freeze the tax threshold, the person will have paid additional £576 in tax, which they wouldn't have paid if government had stuck to his initial tax policy. If you were to look at someone that is earning about £60,000, based on the fact that government is freezing the tax, the person will pay £3,012 extra in tax, which they wouldn't have paid. So the truth is that as government is giving the money through the grant, through the follow scheme, they're taking the money back through another means. So these are payments that people won't have made if government had not changed their policy. But because government is trying to strengthen the public finance, they're trying to get money back. So some of the freebies, let me use that word, that they were giving away before, they're now withdrawing it. And as a result of that, people will be paying tax that won't have paid before. So many people were celebrating that tax rate is not being increased, but in actual fact, it's an indirect tax that government has used to take the money back. The other one that government also is doing to also strengthen public finance is wealth tax. A lot of the threshold for some of these were meant to have been increased based on the past government policy, but they've now decided to take it back. So what they've said is that for lifetime allowance for those who have pension is always about £1,073,100. But not, that was meant to have been increased this year and every year. But government said they are not going to increase it this year until 2026. So for anyone that has a pension pot that goes above that threshold, they will have to pay tax to government. The other one also is capital gain tax. It is now frozen as 12,003. So if you make, for example, for those who have shares, you make money on that. If the amount you've made is above the threshold, you have to pay capital gain tax. Or you are selling a property, the capital acquisition on that, basically you pay. Also, if the gain you have is above the threshold, you have to pay. So government will have increased it before, but they said now they are not going to increase it again until 2026. So the more money you make, the more tax you have to pay. The same thing also for inheritance tax. It is also frozen. The ISA limit ideally will have gone up this year, but government decided they are not going to change it also. So it's still the same thing as £20,000 for an adult that we had last year. So we can see clearly that government is trying to make sure they cap the amount of allowance that they give to people as a result of funding the economy, funding the money that they've given out as freebies. If we do a recap of what I've discussed so far, government is coming in a way, looking for ways of strengthening the public finance by making sure, either directly or indirectly, we pay more tax to fund the economy. And that is one of the things that you'll have seen in the budget. So I'm going to go to the last part, which is talking about building our future economy. One key focus from the government announcement is regarding green energy, green industry. They actually call it Green Industrial Revolution. Government is issuing a bond of £12,000 so that people can invest in that bond. You can buy it through the National Savings and Investments. They've not announced the interest yet, but it's going to be issued, and government's trying to raise 12 billion that they will now channel into green industry. And as a result of that, also, government is trying to attract about 40 billion of private investment into green projects because they're trying to reduce our carbon footprint. And government is saying they want the UK to be the world leader when it comes to green energy. And at the same time, as a way of also helping to boost this industry, government is now coming up with a lot of competition. There's a £20 million that government is saying they're going to make available to fund a competition for people or businesses to develop floating offshore wind so that by 2030, every home will be powered by green energy. Also, government is funding a competition to also develop another, let me say, energy storage prototypes that can help to store any excess carbon that is being generated in the UK. So these are schemes that government is trying to come up with to help this industry. Now, what is the benefit to us? If you see this kind of scheme coming up, that shows to us as individuals that we're here, you have an idea, you have an opportunity to either invest in industries that are in this industry, because clearly, if government is pumping billions and billions of pounds into it, that means the businesses that actually operate in that industry are likely going to be growing in the near future. So if you're an investor, you need to look out for businesses that operate in this industry because there are potentials there. If you also have a business that do something similar here, you may consider actually doing more in this area because this is an area that government is trying to fund money into. Or you feel you want to work in this kind of industry, yes, there's a good future for the business in that industry. So you may consider, let me say, a career in green industry. The next one that government has announced is a plastic packaging tax. As a way of going green, government is saying that from April 2022, which is next year, that every packaging that has less than 30% of recycled plastic will be paying £200 per ton. So it's a way of government trying to encourage us to go green. And that is one of the policies that was announced. The next one that I'm going to talk about is what is called 2-year tax super deduction. This is a scheme that government is announcing to encourage businesses to invest in their business by saying, if you were to invest in qualifying plants and machinery from April 2022, government will give the person 110% allowable expense. So if you're doing your normal tax calculation, there are some expenses that are allowed, there are some that are not allowed. So government is saying, for every amount you spend, they're going to give the person or the business an amount they can deduct from a taxable amount, so that they can have more money available to them to now invest. This is a scheme that the government is trying to use to encourage business owners to invest for their future. That if you invest for your future, we will allow you to have more than the amount you invest into the business. And what is being calculated is that for every £1 that such businesses invest, they will get 25% reduction in their tax amounts that they pay to government. And there are specific conditions that are attached to it. You cannot buy second-hand equipment. You have to buy a new equipment, and there are conditions attached to them. So for those who have businesses that invest in plants and machinery, this is a way of government trying to help those who are doing manufacturing, and at the same time to encourage businesses to invest for their future, so that they can use the money that they get from the government back to do other things in the business. So that is going to be available for 2 years. So any money that is spent from now, this year, and also next year, any amount that is spent, as long as it qualifies, they can use that money that they've spent, even more than that, to reduce the tax that they pay to government. And that is why it's called 2-year super tax deduction. The next scheme that government is using to encourage businesses is the loss carried back. Now, many people are not familiar with loss carried back scheme. Normally, when you make a profit in a year, you do a tax calculation and you have what is called tax charge. When you make a profit, you pay government whatever tax that is due. Let's say I made a profit of £1,000. I'll pay, let's assume the tax is 20%. And the amount that is taxable that's £1,000. I'll pay government £200. If I made a loss, let's say a loss of £1,000, when I do my calculation, let's assume it's still taxable loss, I'll have a tax credit of £200. Many accountants always tell the people, okay, you can carry it forward into the following year. However, there is a clause in the law that allows you to carry that tax back into your prior year. So if you made a profit in prior year, you can actually apply that loss to the prior year and get a repayment back from government. But what government has now done is that they've now extended that condition or provision to 3 years. So anyone that falls into this category, that you've made a loss in this during this pandemic, what government is saying is that you can actually apply that particular loss to any tax you've paid in prior year, and then get a repayment back from government immediately. So I'm going to give us an example. There are conditions attached to it. I'm not going to go into that. So if you look at the next slide, what I've tried to do is to show an illustration of a company called Brown International Limited. So in the first year, 20X1, they made a profit of 15,000. In 20X2, second year, 12,000. Third year, 5,005. Fourth year, 9,000. But in this current year, they made a loss, let's say because of pandemic, of 15,000. If you're going to look at the tax they will have paid over the years, we are assuming 20% now. So this company will have paid 3,000 to HMRC for the first year, 2,004 second year, 1,001 third year. They will have paid 1,800 for the fourth year. Let's assume this particular business wanted to apply the loss carry back, which was in place before now. What they would do is that if they apply the 15,000, they're not supposed to pay tax because they made a loss. So what government is saying is that you can actually carry back, based on the current law, that 15,000 and apply to the prior year profit you made. So in that case, they will apply it to the prior year. So if you look at the amount we have here in the loss carry back, the maximum they can apply is 9,000 because they only made a profit of 9,000 in that year. So as a result of that, if they applied it, so that means this business, if they had used the existing policy, government policy, that means that business will be repaid back the 1,008 that they made to government last year. That's what the loss carryback allows you to do. They will apply the loss you made this year as if it was made in the prior year. And then to the extent of the profit you've made, so in this case, because they made a loss of 15,000 this year, but they made a gain of 9,000 last year, the maximum they can offset is 9,000. So as a result, they were not meant to pay any tax last year. So if they apply that policy, this particular business will apply to HMRC, and HMRC will pay them back 1,800. But what government has done this year is that they've now changed the policy and made it to be 3 years, just to help businesses more. In this case, if you now look at the ones I have at the bottom, because they made a loss of 15,000, so the business can now apply 9,000 to the current last year, which is 9,000 here. Then, because they still have 6,000 left, that business can apply 5,005 to the profit that they made in the 20X3. That is still about 14,005. They still have 5,000 left. Then you can apply that remaining 5,500 to the profit they made earlier. So if you had all that loss back, that would give you 15,000. So what will happen is that based on the calculation, in a 20X4, they won't need to pay any tax because of the fact that they will have used the loss from this year to take over all the profit of last year. So that means they can get 1,800 pounds that they paid to HMRC, they can get it back. Then if you carry over the remaining 5,005 into the prior year, that also shows that they can use the loss to fully offset the profit that they made in 20X3. So they can get 1,100 back that they paid that year also. Then at the same time, they still have 500 left, which they can carry into the third year, which is the limit that government said. And that means whatever profit that they will have needed not to pay will be 20% of the 500, which is 1,000. So if you had all this together, that means right now, the business, if they are doing their filing, they can actually get back from government 100 plus 100, that is 1,002 plus 1,800, that's 3,000. So that means when you're filing your return, if you take advantage of the loss carryback, you can get a cash repayment of 3,000 back from HMRC this year. And government is trying to encourage business to take advantage of that so that they can use it to support their business or to do anything. So this is more or less HMRC trying to say, some of the money you've paid us in the past, you can take it back. But for those who have been managing their tax and have not been paying the right tax, there is a limit to what they can do, because if you've not paid enough tax, you can't get the money. So these are some of the schemes that are available. And then the other one I need to talk about briefly is free ports. There are 8 port areas that have been, designated as free ports in the UK. So if you look at the map that I have to the left, I have those 8 areas there: Liverpool City Region, Teesside, Humber, East Midlands. Government is saying any business that is set up in those areas, they won't need to pay tax, either stamp duty, capital allowance, business rates, customs, and all that, and also even national insurance. So for those who consider investing, they can invest in these areas, because what's going to happen is that if business start moving to this area, the value of properties or business is going to be going up. So it's an incentive for business to move there. So if you have money to invest, you may consider this area. Or if you have a business, you may consider moving into these areas, because you're going to be paying less tax as a result of not paying a stamp duty, not paying business rates, not paying capital allowance, or not paying even national insurance. These are incentives that government is trying to use to help businesses. And there are other incentives also that government is done to help. So if you look at the others, they're talking about investing about £1 billion in about 45 towns all over England. So if you know those areas, for those who have the money, you can start considering investing in those areas. Talk about Middlesbrough, Preston, Sweden, Bournemouth, Ipswich, so many of them. So if you go on the government website, you will see a lot of these areas that government is trying to pump money in to help the businesses to survive. And finally, we've talked about a lot of grants that are available to businesses, a lot of support are available. What government has realized that several businesses that don't qualify have gone in, or several individuals that don't qualify have gone in to take the money. And if you look at the cutout of some of these headlines that were taken from different places, there was an estimate that government could lose as much as £26 billion But as the last result that was provided by HMRC, they said about 3.5 billion of follow money has been claimed either fraudulently or in error. And what government is now doing is that they are trying to clamp down on the people who have been taking the money illegally or fraudulently. So if you look at what they've done, is that they've been going about investigating and prosecuting people. If you look at the charted out, I didn't show the face of the individual. 2 people on the 17th of March, 2 people were jailed for claiming back COVID bounce back loan of almost about $500,000. And right now, government is investigating several of those cases by jailing people and at the same time, even asking them to pay penalty for almost 100% of whatever amount that they've actually claimed during the period. So what we're trying to say now is that if we have individuals here who for any reason have claimed money from government, either unknowingly or by error or been advised wrongly by someone, you may have to go back and assess if you truly qualify for that loan. Because right now, government is making available £100 million to HMRC for them to employ about 1,300 people to start investigating and then so that they can start prosecuting those who have fraudulently claimed the money from HMRC. So please, we advise that if you know those who have claimed, ask them to assess if they've truly qualified for the money. If they don't, they need to make arrangements either to pay the money back or look for a way of getting money to regularize. Otherwise, if government were to come down, they will pay penalty and such individuals or businesses may be prosecuted. And then, as you know clearly, as we see in the last example, that people are already being sent to jail. To avoid such things, they need to make sure they repay back the money before HMRC come after them. And also for those who are probably looking for jobs, HMRC is employing almost 1,300 people. So these are also an opportunity for people to get to work with HMRC because they need about 1,300 people to do this investigation. And this job is going to continue for a long time because many people have applied for the money. And this is an opportunity for those who want employment opportunity. In summary, we've shown clearly what government is doing to help people to survive and also at the same time to thrive and for the public finance to come back. So I've mentioned that I'm not going to go through them again. So these are just a recap of some of the key points that we have in there. So now we've come to the end of this presentation. Before we go to the next part, we're going to have a poll, which you're going to see on your screen. The poll is going to be, they're going to have 2 polls. The first, what we're trying to do is to identify which of the areas we discussed you want us to further discuss, further analyze during the breakout session, because we're going to have a breakout session where we're going to be discussing in more detail. So you're going to see a poll, which we wanted to answer top 3 areas that you want to be further discussed in the breakout room, because we're going to have 2 breakout rooms, one for the economic outlook and one for the budget. So please kindly answer the poll and select top 3 that you want us to further discuss by the time we go into the breakout rooms. So so you can see on your screen now, those are the that's the poll. Just select the top 3. You can only select a maximum of 3 for question 1 and then 3 or question 2. So based on the results we get, we're going to discuss those top areas during the breakout room. So while you're doing that, I'm going to hand you over to Deji, who is going to take us in the next session. So thank you so much. Thank you for listening.
Thank you, Emmanuel. I will leave this poll on because there's 2 polls. So this one I will give another 15 seconds and then I will launch the second one. So please, can you just click through? Right, I will be ending this poll in 5, 4, 3, 2, 1. And while you're looking at those results very quickly, I'm going to share the next poll. based on what Emmanuel explained, can you also just do the same with this one, just the top three, please? Person, let's try to hurry this through so that we can move on to the next section. And also just to set some expectation, we want to give you as much time as possible in the breakout rooms. And even though we have another 25, 30 more minutes of the investment outlook, we just want to set the right expectation in case we run over time in the breakout rooms. It's important that you guys have the time to ask the right questions and to get the clarity that you need based on what has been covered so far and what will be covered over the next 25, 30 minutes. So I'm going to give this 15 more seconds, and then I will close the poll and move on to the investment outlook. Okay, so counting down 10, 9, 8, 7, 6, 5, 4, 3, 2, 1, and ending the poll. Okay, well, while that's still on the screen, please close it down for yourself in terms of the poll results, but I'll leave it up for the next 10 seconds while I go through the investment outlook. Just a quick notice. We obviously have different levels of experience on this call. So jargon alerts, in case you are new to some of these terms, that's fine. We have the breakout room for that. You can ask questions. It's important to stress this. We've covered it in the disclaimer. Everything I'm going to reference in terms of stocks is just for illustrative purposes. So I'm not recommending any of these stocks. Please post comments, questions as they spring to mind. Don't feel like you have to wait to the end. We will pick up some of those questions and probably start off with them as we roll into the breakout room. I already mentioned that all will be revealed. And so keep calm and let's carry on. Right, so we've now talked about economic outlook. You've looked at some specific angles of the budget, and things are improving. We can see that. We can see from a global perspective, we had a contraction last year, but the forecast for this year going forward, things are improving. We can also see earnings outlook looks very positive. The S&P 500, which we've covered in one of the previous webinars, is a US index. You can see that the global benchmark is saying things are on the up. But let's kind of step back and look at where we're coming from, which is what I've tried to give you in the economic outlook. Let's look at where we're coming from a stock performance, financial markets perspective. So I've just picked the top global indices in the world. So obviously we know the S&P 500, which is 500 large companies in the US listed companies. I believe we're familiar with the FTSE 100, which is index of 100 listed companies on the London Stock Exchange, the Dow Jones US as well, NASDAQ, and the stocks Europe is for European companies. So let's look at some of the performances, right? So you can see here, the S&P 500 in last year returned about 16%, which is pretty good. But again, if you're one of the brave people and you bought during the massive sell-off in March that we experienced after the initial sort of fear of coronavirus, no one knew what it was, you will see that you would have returned, if you were brave to buy in that time, 63%, which is a very, very healthy return. Now, I'm going to pick two more for the sake of time. You can see the FTSE 100. The FTSE 100 didn't do so well last year for reasons that I've explained in the economic part as well, which is tied to Brexit fears as well and underperformance of the UK economy in general. But again, if you were brave when things were selling off and you decided to buy during that time, you would still be up. the one I really want to focus on, because I think that's a lot of where growth stocks and future-looking companies sits, is the NASDAQ. The NASDAQ is, again, similar concept to the S&P 500, but it's very technology-heavy focused companies in the US. If you bought the NASDAQ last year, your performance is about 43%, and returns from the lows is almost 90%. I mean, that's very, very impressive. So if you are one of those people, congratulations. I will now pick a few selected stocks. Again, I'm not recommending any of these stocks. This is just for illustrations. Let's take Tesla, which is one that I'm sure everybody is familiar with. I mean, 2020, you can see the Tesla returned 720%. I mean, that's phenomenal. 7 times your money if you were one of those people. I wasn't fortunate enough to be one of those people. So if you are, congratulations, pat yourself on the back. And you can see in the same case as Zoom as well. You know, these are phenomenal performances. Microsoft, Apple, these technology companies, if you were brave to pick up from the lows of the sell-off in March last year, you're talking about 131% return on Apple. That's like usually what you'd expect over a 5-year period. So these are very impressive performances. But again, you can see that not all industries have benefited based on 2020 performance. So I've picked a few sort of airline, AIG, EasyJet, and then Shell, which is an energy company, which didn't do so well, but still, bravery, or as they say, fortune favors the brave. If you still went in during the sell-off, you're still doing quite well overall in terms of performance. So I think we can all agree that last year was a pretty good year. Now let's look at stock performance for 2021 as we are. So this is till date, up until last night, I believe. Well, actually, sorry, 2 nights ago. So if this has changed, it's just very slightly. Using the same sort of thinking, now the headers have slightly changed. So 2021, these are returns, but the decline from recent highs. So what do I mean is the stock has gone up significantly, but now it's starting to come down. Is that delta change from recent highs? Net for all these indices, we're doing pretty well so far in 2021. But again, you can see that some of these are starting to pull back from their recent highs. Where you see not applicable is because it has kept going up. But let's look at the NASDAQ and some of the components of the NASDAQ, right? The NASDAQ has dropped about 5.6% from its recent highs. And, you know, there's a lot of sort of jitters in the markets and fear of, have we, you know, gone too far? Now, let me pick again those stocks that I talked to you about for 2020. Take Tesla. So performance this year, not so great, but not too bad either compared to where we were last year. But this has been pulling back significantly. We're talking almost 25% in the last 6 weeks or so. It was actually worse than that a few weeks back. It was almost 40% at one point, but it's starting to recover a bit. And so you can see some of this volatility starting to sip into the market. Zoom is another one that is pulled back significantly from recent highs. As I mentioned, I'm not going to go through everything, but I wanted to give you a flavor of how to start to see the ones that didn't do so well holistically last year, IAG, EasyJet, Shell, are starting to pick up again. So it's fair to say there's some inconsistencies in the sense of last year, this year. And what I'm hoping to do is try to give you a flavor as we look at investment outlook, some of the things you should consider as an investor. And from that perspective, maybe sort of let's stop here and take some time to complete this poll and think about, from your perspective as an investor, how you feel about what's happening in the markets today. So I'm gonna launch this poll. Please just punch in your answers. There are 3 questions, And let's just go through this over the next 1 minute. So have you made any investments in the stock market, particularly since our first webinar last year? Please put in your selections. I can't see any selections at the moment, guys. Let's try to engage on this. I'm assuming that you can see my poll. Yes, okay, I can see some, maybe a delayed effect. I can see some responses coming in. The second one is, how do you feel about your investment so far? And the third one is, are you worried or concerned about your investments? So I can see, yes, the numbers are coming in, 35 people. Okay, let's keep going, please. I can see we have about 140 people. So it'll be good if we can get to about 100 people really telling us about their feelings and also their choices so far. Because you have bought at the lows if you were brave, or maybe you've bought at the highs and you're like, oh, wow, I've lost like 40% of my portfolio already. It's fine, it's okay. There's no need to panic, but just let's express where we're at in terms of our investment journey. Right, I'm going to give this 10 more seconds and I'll close it. We're almost at 100 with my 84 now. Keep going. 5, 4, 3, 2, 1, and I'm ending. Okay, so how do I try to end the poll, but it's not working on this end. Okay, right, sorry. I hope you guys can see my screen. Sorry, the results. So 25% of people have made investments and have had some for a while. 29% more recent, no, I haven't. And some are still sitting on the fence. So a big portion of people haven't on the call. The second question is, how are you feeling? 13% are quite happy. So those are probably the ones who have been in the market for a while, or the brave ones. About a third of people are still waiting patiently for better returns. Some people are nervous. Some people are not sure how they feel, but 50% are nervous or not sure how they feel. So I hope this is applicable to you and can help you as we look at the investment outlook going forward. Are you worried or concerned about your investment based on recent volatility? 21% say yes. That's good. I'm really happy to hear that. And I hope this will just even reinforce that thinking as well. 33 said I'm not sure, and 6% don't know, don't care. So that's very helpful. I'm going to stop this now, stop sharing. So please close the window and we'll go into some of the themes that are developing for this year. So you can see that we've gone from 2020, where we had economic uncertainty, people were not sure what was going on. We were in lockdown and the stock market kept going up, right? And then we entered 2021 where things are looking positive. Vaccine programs are rolling out and the markets are kind of like, I'm not quite sure where we're going. Well, the first thing to consider is that markets are based on future expectation. So what I mean by that is, if you're wondering, well, why is that happening as a delayed effect? Why is it that when things weren't good, we were going up? The reality is markets look at after the fact, not during when things are happening. So after the fact is where we are now. The hope is that we're already coming out of the pandemic. Things are looking up. So what does the future look like? And some of these themes are what I'm going to try to break down, but focus on one as we walk through this presentation. The first one is the rotation from growth to value. What do I mean by that? Well, growth stocks are revenue, stocks that revenue and earnings are expected to increase at a faster rate than an average company. So a growth stock can be Tesla, for example. You might say, well, Tesla doesn't make that many cars at the moment, and that's very true. They truly don't make that many cars. But the future expectation is that because of rising consciousness, because of the fact that we need to save our planet, we need to move to electric cars at some point. Now, if Tesla is the leader in this space, the future tells us that if they have 3 out of 10 cars on the road, that's a big big market share, which means revenues and earnings for this company will grow significantly in the future. So it's very future looking. On the flip side is value. So value is things that have been neglected, right? The fundamental value is still quite solid in terms of earnings and sales. Maybe it's suffered a dip because of the virus. So like airline companies, if no one is traveling, obviously they're not making any money, but it doesn't change the fact that when things open up, we will travel and these earnings will grow back. So these are value stocks where they're trading lower than their price relative to fundamentals. And so there's a shift that you're starting to see, and I hope those numbers showed you from growth to value. The second thing is actually, are we just in a bubble? Did we kind of, we're all sitting at home bored, nothing to do, nowhere to go, nothing to spend our money on, and we're just hitting buy buttons and we enter this crazy bubble territory? Because I mean, 700% in a year, that's ridiculous. Let's be fair. No company has a justification for 700% returns in a year. So did we just go too far? And this is just a healthy correction, especially because of this disconnect between the real economy, which suffered, and the stock market, which was doing significantly well. Or are they just other forces and threats to the economy and to recovery of corporate earnings, as well as bounce back based on the schemes that we've discussed in the budget? Now, some of this overheating, this sort of forces, these threats to the economic recovery, I will break it down, but I really want to focus on a key theme in the market today, which is inflation. So if you follow financial news, I'm sure you've heard a lot of that rhetoric around inflation is coming, inflation is coming, inflation is coming. If you don't follow financial news, then this is just treated as just an education piece, right? And it helps you as an investor to really understand macro themes that are developing. So what's my goal today? To leave you feeling calm if you're feeling nervous. I know some people said they were feeling nervous. 50% plus were unsure and or feeling nervous. So let's leave you with a feeling of calm, which is our role here. And more importantly, for those, even if you're in a good place and you've been one of the fortunate ones to make a significant amount over the last year, just to leave you enlightened as an investor. So as I mentioned, the narrative today in the market is inflation is coming, right? So what does that mean? Inflation means increase in price of goods. And I'll play a short video to demonstrate that. But the impact of inflation is as follows. Now, I may not spend as much time as I would like to here to explain it in detail, but I will spend the time in the breakout rooms to break it down as and when you need. But the impact is that interest rates will go up. If inflation comes, interest rates will go up, right? Which is not a great thing because interest rates need to be low for us to recover from the pandemic. That means the yield curve is going to steepen. So that means the short end of the curve and the long end of the curve, the gap is going to increase, the spread, which is a sign of recovery. And the summary of all what I've said and some of the technical jargon I'm using is that the stock market will correct. You can start to see some of that playing out now in some of these stocks that have gone up too fast, too quick. So just to reiterate some of the rhetoric that you can hear in the markets, Bailey is one of the Bank of England governors, and he's raising, there is a concern about post-pandemic inflation, which is usually they try to target about 2%. You can see on the other one, Wall Street, their biggest fear is no longer COVID, because again, remember I mentioned future expectation. The market doesn't care about what's happened in the past. They care about what's happening in the future. We're not worried about COVID anymore. We were before, but now we're worried about inflation. So let me just recap inflation for the purposes of those who may not be aware, and then I will elaborate on that some more.
Inflation is the increase in prices of goods or services over time. Dan just got paid and needs to buy groceries. Dan heads to the grocery store and loads up his cart with the items that he needs. These items cost Dan a total of $100. A year later, Dan returns to the grocery store with $100 to purchase the same items. However, now the same items cost $105 and Dan is forced to remove an item from his cart. Dan has experienced the effects of a 5% inflation rate. Dan must pay $5 extra to purchase the same items that cost $100 only a year ago. Inflation leads to higher prices and lower purchasing power. It's usually a monetary phenomenon caused by a country printing more money than is justified by the country's wealth. When more dollars are issued for a limited amount of assets, the value of each dollar is decreased. Many countries' central banks set an inflation rate target of 2 to 3% per year.
Okay, so I hope that's kind of given you a quick flavor, but let me just put it in motion, right? I'm going to look at it from a consumer perspective, so that's you and I, and a company perspective. So I'm introducing back again, Alexis, one of our sort of pseudo characters from a previous webinar. Alexis earns $30,000 a year, for example. Inflation is coming, inflation is coming. It means that Alexis $30,000 and the things she can buy with, as you can see, her purchasing power goes down if inflation goes up. The things she can buy with a $30,000 is going to be less. Now, multiply Alexis by 100,000 or 1 million or maybe 2 million. If 2 million people can buy less things, that's obviously not good for Joe Bloggs as a company. Why is that? Because people are buying less from them and therefore their earnings are less. So think of it, revenue minus cost is profits, right? So if your revenue goes down, your profits will likely go down as well. So that's the side of the impact on the economy, how inflation hits. Now, from a company perspective, there is what I've explained from Alexis to the company, but actually companies also borrow money to fund their operations. So they borrow money from you and I, they borrow money from the bank, they borrow money from governments. If inflation goes up, I mentioned about the connection with interest rates, it means that interest rates will go up. So if they're borrowing from banks, their repayment is already higher. If their repayment is higher, that affects the cost of business for them. And if it affects the cost of business, again, back to the simple principle of revenue minus cost is equal to profits. If cost is going up, revenue is going down, that's bad for future profits expectation, and hence why you're seeing some of this repricing in the markets. But before I carry on, let me give the argument that says, okay, let's understand this logic of inflation is something we need to worry about, agreed, but why inflation, and is that argument true? So I'll give the for the argument, and then I will look at the against for the arguments. So the for the argument is the central banks are printing money, there's too much money in the system, governments are spending money, there's too much money in the system. From a central bank perspective, if you're familiar with the financial markets, you have heard about the QE programs, which is quantitative easing. It's basically like printing money, giving money. I mean, they don't really print money. It's numbers on the screen, but the point is they give money to ease friction in the markets. The central bank have one purpose only. Well, they have two, but the primary purpose is their job is to ensure that there isn't financial friction in the markets. Their job is to make sure that if Alexis needs to get a £5,000 loan, she's able to get that. Because if she's not able to get it, then she's not able to spend, she's not able to run her life, and therefore the economy grinds to a halt. So think of their role as increasing money supply and encouraging lending and investments. Now, the other argument for inflation is that we have these supply constraints due to the virus. Now, some of this is easing because things are somewhat getting back to normal, but still, some people can't go to work. And if you have these supply constraints, that means that you have the same amount of demand chasing fewer goods. Now, that increases the price of those goods, and therefore inflation picks up. So these are some of the fears that we're seeing. We've seen some sectors that are completely grounded, flights, even some freights as well. Those things affect the supply stream into an economy. And then, as I mentioned before, I'm not going to belabor the point about the massive stimulus from governments. These things also put money in our pockets. The money has to go somewhere. We have to spend it on something that increases price. And then finally, the large sort of private savings. Now, I'm going to bring this into graphs in a second, but if no one is going anywhere or buying anything, then we just have a bunch of money sitting in our bank accounts, right? That's just the reality. We're not eating out, we're not traveling, we're not buying new clothes. So we have a lot of money just sitting in our bank accounts. And just to put that into some context for you, this goes all the way back to 63 for the UK and 1950 for the US. But you can see the correlation where at the peak of the pandemic, we were saving, our savings ratio was just under 30%. So what do I mean by that? For every pound that I earn, I'm saving just under 30 pence of it. We don't normally have that. The average, as you can see with the line, would be around eight pence that we save per pound that we earn. And even now, we're still just below 20 pence. Similar to the US, the same sort of phenomenon. How does that translate to demand? It means that there's pent-up demand. I'm sure some of you can't wait for restaurants to open. Sure, some of you can't wait to go on holiday. Some of you can't wait to buy new clothes. That pent-up demand means we even have more money going after the same things. So if you have more money going after the same things, that obviously increases the pressure on prices. And therefore, you have this sort of rhetoric around inflation, inflation, inflation. So I hope that's kind of given the argument for this strong historical link between the two. The idea is very simple. We print more money, money becomes less valuable, simple supply demand of economics. More money chasing the same goods, as I've mentioned. That's my argument for. Now, the question, what I want to do is debunk that myth, is does it make sense? Do we see that in the data today? So I'm going to spend the next few minutes doing that, but maybe I will give you a quick history of inflation. I've put these in sort of a lighter shade gray. I'm not going to go through it, but for your reference, in case you wanted to do more research in your own time, the gold standard was what we used back in the 70s. That was abandoned back then. So money was pegged to gold. It's no longer the case, strictly anyway. But after that, we started to see a lot of volatility in inflation. So the numbers of volatility, which I will show you shortly, just crazy. They were out of normal range. I mean, in Zimbabwe one time, I think inflation was almost about 1,000%. That's just not sustainable. Now, this guy came, super smart guy, economist, and says, this is ridiculous. We can't live like this. Like economies can't survive like this. So he kills inflation. He says, this is not sustainable. Let's start to peg this thing to what they called an average inflation target. And a lot of this is the work of the central banks. So since 1990, inflation has been, on average, about 2%. You get some of it will spike a bit higher, but in general, it's about 2%. Now, if you don't believe me, I will show you the data, right? So let's take, since 1958, as I mentioned, you can see that we were in really unsustainable territory. You go out to buy a carton of milk that was £1, and the next day you go out and it's now £1.25. That's not sustainable. So you can see these numbers for developed economies, by the way, US, Japan, Germany, UK. Once we had that cut off and we had better sort of management of this noise, it's very clear to see that if I was to draw a line about an average there, we're roughly about 2%. And even if you wanted to push it for some of maybe the US points, going up to 3-4%, or the UK at one point during the financial crisis, because of the fact that we had real strain on the economy, it ticked up to 4 or 5%, but you can see how it normalized very quickly. Now I'm going to go to a wider sort of emerging market view as well. So you can see advanced economies very, very clearly. We went from the crazy highs of double digits and slowly tick down since 1990. We haven't seen this supposed spike in inflation. And some people might say, well, I see this in Nigeria, that's where I live, or in Brazil. That's true. It was higher before, higher 20s. But again, since the 90s, you can see this is a consistent global theme. Inflation has been well under double digits for almost 3 decades. And the truth of the matter is, inflation narrative is not true anymore. They're credible anchors that really hold the value of our money, that keep companies and prices in check. And these central banks have so much sway over the financial markets these days that it's like, if I say to you, don't think of a blue elephant, what are you going to think about? A blue elephant. And so that's what you're seeing. It's almost a self-fulfilling narrative by itself. So this has kind of led to very low volatility of inflation. Now, to add to that, we have globalization, which we didn't have significantly back in the 60s, 70s. We are now a more integrated world. What do I mean by that? We don't produce everything in the UK. We don't need to produce everything in Europe. You've seen the rise of China. If there's a shortage of rubber for us to make tires and trainers and whatever else we use rubber to make, we just import it from China. So that eases the pressure of overheating, where you don't have the same amount of money going after a finite number of goods, because there's now globalization to sort of, like a valve, almost release the pressure on the valve. And you've seen that has led to low and stable inflation. The central banks always anchor around that 2%, and history has actually shown, especially for the last 20 years, that they've struggled to sustainably maintain that number. Now, I think it's still prudent for me to say, even though inflation, in my view, is not anything we need to worry about. So all you're seeing in the market now is noise. For those of you who are nervous, it's noise. But it's still important to point out a few things, because inflation is transitory in the sense that it may not be here to stay, but it could affect portfolio management, how you have and diversify your portfolio over the next year or two. So I'm just going to mention a few strategies for hedging against inflation. The first one is start to think about industries that benefit from the reflation trade, so the higher inflation noise. And industries like financials, industrials, I showed you aviation already, and energy. Why do they benefit? Well, financials is quite simple. If interest rates are higher, that's good for banks because you're more likely to save and they'll make more money off you. So that means their profits are likely to go up. Industrials as well, again, in a temporary state, there's few raw materials, so the raw prices of those raw materials go up, which is good for their profits. And in energy, if demand goes up, we are using more energy. So that's also good. And you probably noticed that the price of oil is going up significantly. So think about portfolio diversification. Don't put all your eggs in one basket. Don't just go after technology and the things that look pretty and the things that everybody's talking about. Diversify your portfolio. We are long-term investors, so we should always keep a balanced perspective on that. The second one is buy the dip. We introduced the concept of dollar cost averaging in one of our previous webinars. It's quite simple. Just buy consistently. Don't try to time the market. If you buy at the high, buy again at the low, provided it's a company you believe in, because what that does is it reduces your average cost of a stock. And as I mentioned before, everything we try to encourage you to be and do is to be a long-term investor. In the long term, the noise is just noise. Ignore the noise, maintain a long-term view. And this is one of the things that we preach and teach on a lot of these webinars. Volatility is here to stay for 2021, in summary of what I'm trying to say. So just keep that view of there will be a lot of noise. So it's how can I hedge my portfolio against this inflation noise? I'll just finish real quick against on the risks to the recovery. The key things that I'm looking at this year, and I think are the things you should maybe keep as a perspective on what could really impact or be damaging from an outlook perspective for investors, is persistent health crisis. You can see the graphic on the left. Recently, AstraZeneca had to suspend or some of the vaccines simply because there were talks about a possible side effect. So if that happens, that obviously leaves us in this state of limbo even longer and further lockdowns, which is not good for recovery. new strain as well definitely isn't good. The other thing is, if growth isn't as strong as we're projecting it to be, remember we're taking a lot of debt on governments, individuals. If you have sluggish growth, that could lead to potentially a debt crisis. I can discuss more about stagflation or what that means, but in effect, if you have high inflation coupled with high unemployment, that's bad. So you can see some of the things that the government is trying to do to keep unemployment very low. But what happens if demand stays low and unemployment starts to rise up? That's terrible for the economy. So these are, again, some things to watch for. Very, very unlikely, but it's still a possibility. And to finish from a global perspective, you could start to see policies from governments and central banks not very coordinated. I mentioned before, we're living in unprecedented times in the sense that we've never seen this level of support from both central banks and governments before. So if you start to see that divergence, that could potentially lead to even more jitters in the stock market. And then finally, for the UK, the reality of Brexit, we still don't know, simply because we've been dealing with a virus, what the true impact of trade and talent is going to be. I'll just finish on Proverbs 19:21. After all is said and done, the Bible says, many are the plans in the mind of a man, but it is the purpose of the Lord that will stand. At the end of the day, these are all just forecasts. So with everything we do, with our investments, with our time, we commit it into his hands. But stay calm and see you in the breakout sessions. Thank you.